Okay, now we're going to talk about asset retirement obligations. This is an overview for dismantlement and environmental restoration costs. Again, I'll talk about this a little bit. We are going to use the same rules, whether we're successful efforts or full cost. But I did want to let you know that this is not just, again, for the upstream industry. This is for any industry where there are environmental concerns. So, for instance, if you are running a nuclear power plant, you have environmental concerns because at the end of the life of your uranium core, you have got to be able to put that in a secure underground location where there won't be any radiation leaks and so forth. So they would have to deal with these kind of issues. Any kind of issues, chemicals, any kind of, depending on what industry you're in, if you've got environmental issues, you have to deal with these asset retirement obligations. Or you might call them environmental decommissioning costs, because you're decommissioning, some companies talk about decommissioning costs, because you're decommissioning your platforms and so forth. So we're going to handle it the same, whether it's successful efforts or full cost. So that's nice. We're not learning two different ways. But this statement basically says you need to set up a liability for this future liability. You need to set up a liability on your balance sheet for this future obligation, even though it may be many, many years away. So, for instance, I looked at Northern States Power, and I looked at their 10K for 2013. And they do have an asset retirement obligation set up, and in their notes for their uranium core, they talk about it, the disposal of their uranium core. And they believe that that's not going to happen until 2091. And they say at least 2091. It's always an estimate, right? But they have to account now, they have to set up a liability for the year 2091 when that uranium core is going to need to be put into a secure underground environment. So we say when the environment is first disturbed, we need to estimate that future liability and record the present value of those costs today. Time value money, obviously, 2091 is a long way away. Now again, you don't have to unless you have a contract that says you have to fund, which some contracts will say in the oil and gas industry with your partners. You don't have to have a bank account and be funding these year to year. If you're ExxonMobil, you do have some situations where you have to fund because it's in the contract. But for the most part, you're not funding these. You are managing them in the finance division, right? You know what's coming up every year, and you know what your cash needs are. So you're managing your financing of these as well as your financing of all the properties you're working on. But the idea is we don't want to have off-balance sheet liabilities. That's why this statement was written. Came into effect, I think, in 2003 or 2004. I think it was 2003. But the reason the statement was written is so that there are not off-balance sheet liabilities. Remember, we went through a period of time where there was a lot of concern about companies having off-sheet liabilities. And that was because of some big failures that happened, right? So this was one of the things that came out of that kind of era is that if you're in an industry where you know you're going to have these environmental or decommissioning concerns, we want your financial statement users to know that this liability is there. You have that liability, even if it's many, many years from now. Now, I'm going to say in the oil industry, it's probably not 2091. I doubt that anybody has a property going out that far. But I do know there are some 50-year ones. Now, that's kind of a long time, too, but there are some 50-year contracts out there. There's definitely 20, 15 years, 25, 30-year properties. Okay, so as soon as I disturb the environment, I need to say, what's it going to cost me to decommission this. And I need to record that as an asset and a liability. And we'll look at what assets and liabilities those are. But the asset is going to be included in the DD&A calculation. And of course, I don't know what it's going to cost me 30 years from now. I can make an intelligent guess, but I do have to reassess as I go along. As I get closer and closer to actual decommissioning, I'm going to know more and more, right? And so I'm going to reassess the liability, and we're going to show how to do that on a regular basis when events occur or information comes to light that indicates that the liability may have changed. So you could do that on a regular basis. For instance, ExxonMobil looks at a third of their properties each year. So they're kind of on a 3-year rolling basis. So they look a third of the regions of the world each year, kind of roll along. Okay, again, this wasn't written just for this industry, so the rules on how to apply it are fairly general. But the statement does say when you project these future costs, you must consider inflation and technology. Now, advances in technology will drive down prices, but inflation will drive up prices. So you have to decide, if this is 30 years from now, what is going to be the net effect between inflation and technological advances. For instance, the very first 4-function calculator I bought was Texas Instrument 4-function calculator. Now, I'm pretty old. They came out when I was in college, and it was just a great thing. Whoever thought you'd have this little calculator? I mean, it didn't do very much. It did add, subtract, divide, multiply. And Texas Instruments came out with this. I bought one for $100. It was about $100. Now, those aren't in today's dollars, right? Those are in somewhere around 1978, some 79, somewhere in there. Those are in those dollars, right? So today, I can get those 4-function calculators at Walmart for $1. And I do often buy them for $1 because students will forget them sometimes when I'm teaching. And so I always have a lot of extras in my desk. Back then, that was $100. And the first microwave I ever bought, I bought a microwave barely when they came out. It was $750. A nice microwave, but $750. Today, I mean, look what you can get one for a dorm room. Gosh, you can get them so cheap now. You can get little ones sometimes from Walmart, $39. I mean, advances in technology, you see that in computers, you see that in everything. Things that first coming out, I look at them and I go, well, I'm not going to buy that now. Looks nice, but in a couple years, the prices are going to be way down, right? Because it's going to cost more when it's first introduced to the market as technology advances and things get marketed more and more. Prices tend to fall down. So we're going to have to make some assumptions. Now, your assumptions need to be reasonable, but you don't have to match other companies. So some companies, for instance, say, yes, we know there's going to be technological advances. But we also know there's going to be inflation, so therefore we assume that inflation will be offset exactly by technological advances. Other companies say, well, inflation is going to offset technological advances, but not completely. So maybe we'll add a 2% inflation factor. I mean, again, you have to, it's your judgment. It has to be reasonable, but it's your judgment. Now, again, every company has a materiality level. So if you're working in a field where this is not going to be very expensive, and your materiality level is going to vary from company to company depending on your operations and management's determination. So if you're in an area where this is not going to be very costly to do, it's under your materiality level, then you wouldn't have to do it. But your materiality level has to be reasonable, again. I would say offshore, when you have offshore platforms, and you have production facilities and things, production platforms, production facilities, this is almost always going to be material. I mean, some places onshore, it may not be material, but offshore it is certainly going to be material because you've got to dismantle those platforms, right? Take them away, secure the environment. If you look at the North Sea, it is tremendously expensive in the North Sea to decommission. And we're getting some fields in the North Sea that are decommissioning or in that process, right? Because some of those areas in the North Sea are already ready, to be decommissioned. They have produced all they can. The environment of the North Sea is so harsh that in order to drill in the North Sea, especially when they started drilling in the North Sea, they put tons and tons and tons and tons of cement because they said that's the only way they could assure that those platforms weren't going to go anywhere in the harsh environments. So now as decommissioning is coming along on some of these older platforms in the North Sea, they're finding that it's very expensive, even more expensive sometimes than they anticipated. But again, we're going to reassess the liability as we go along. So as we get closer and closer, we'll continually reassess. So this initial estimate is just that. It's an initial estimate. As we get closer and closer to actual decommissioning, we're going to be reassessing this. But that liability does need to be on our books. Okay. So first of all, let me say that onshore, we say the environment is disturbed the first day you really go in and do anything. You build a road, you level the land, you cut down trees, you do grazing, you get the get the area where you're going to put the platform in ready. That's when the environment is disturbed. Offshore, it's generally when the drilling platform reaches location. So in this example, Peters Oil is planning to drill offshore on Block D. The drilling platform reaches location on January of year 1, say January 1 of year 1. Peters estimates it's going to cost $10 million for future asset retirement costs on the block. Retirement, they think, will take place in 20 years. Again, that's still an estimate. I'm going to reassess that as I go along. And Peters would be able to borrow today at 6% to fund the future obligation. So that's the percentage rate that's appropriate to discount at. The present value factor for 20 years at 6%, and you've got calculators that probably go out to more decimal places than this, but for our purposes, just used a present value table, so that present value factor is 0.3118. Okay, so it's going to cost me $10 million 20 years from now. I'm going to take the present value of that back to today, 0.3118 was the 6% rate for 20 years. That means I need to set up a liability for $3,118,000 today. So that is going to go into an asset retirement obligation liability. It's going to be increased on the balance sheet. A lot of companies refer to it as ARO. It's very commonly called ARO. So if you hear of ARO, that's what that is. It's an asset retirement obligation liability. Now, your other side, though, you have to create an asset, is going to go into wells and equipment for this field. Wells and equipment is increased on the balance sheet, $3,118,000. Now, that wells and equipment, we haven't really spent that money yet. And again, unless we have some kind of contractual obligation, we haven't funded anything yet. So this is wells and equipment. Sounds a little odd, but we're putting it in wells equipment because, it is a necessary cost of using the wells and equipment, even though the cost isn't going to come until the future. But this wells and equipment asset will go in the DD&A calculation, along with all of your other well and equipment costs. So that will be in your DD&A calculation. So wells and equipment increased $3,118,000. ARO liability increased $3,118,000. Now, we're not going to retire this or decommission for 20 years. So this liability of $3,118,000 considers the time value of money. In other words, if I wanted to, I could invest this today at 6%, and then I'd have the amount I need in 20 years, the $10 million. I have to account for the fact that every year I'm 1 year closer to retirement, right? So just kind of like anytime you're doing anything with time value of money, we have to accrete discount. So this liability needs to grow over time, over the 20 years, until we get the full $10 million in it. And that's called accretion of discount because we did this at a present value. So this was remember the liability was created in January of year one. At December 31 of year one, a year has passed, we need to accrete discount. Now we're only 19 years away from retirement. So we're going to use the current liability balance, ARO liability balance. Current balance is $3,118,000 times the 6% discount factor we used. That's $187,080. That is our accretion for the first year. That accretion is going to be expensed on the income statement. It's a finance type charge because it's associated with the time value of money. Right? It's a finance type charge. It's going to be in with your interest charges. Accretion expense is what a lot of companies call it, but they'll put it with their interest charges on their consolidated statements. And then we're going to increase the liability by $187,080. So the liability balance has gone up now. $3,305,080. Okay, so the liability is going up each year. Now, I'm not going to carry it out all 20 years. You can if you'd like. You'll see it's probably going to be a little bit off because of the present value factor having a limited amount of decimals. But if we go through to another year, we'll see that at the December 31st of year two, we now need to take the second year's accretion. So we're going to use the new liability balance coming into year two was $3,305,080. That's a larger balance at 6%. That's $198,305. So accretion is expensed on the income statement, $198,305, and the liability is increased on the balance sheet. So accretion is expensed as a finance charge, and the liability is increased. The liability balance now went up by $198,305 to $3,503,385. Okay, before we get into changes, let me point out something here that I think was very interesting. Before this statement came into play, the industry had to account for these future obligations. That was an oil industry standard back in what the old oil industry standard we called FAS 19. Now they didn't really say how they had to do it, but they said that if you're in this industry, you have to account for these future liabilities. It's decommissioning type cost. And so the way most companies were doing it, I'm going to add in here a little graph. And on this side, we've got time. And on this side, we've got dollars. So right up here at the very first, right, that's where we get the contract. So I'll just call it a lease. That's where we get the lease. And pretty closely after that, we're probably disturbing the environment. So we're disturbing the environment right in there. Pretty close. But by the time we start producing, right, we may be out to year 5, let's say. So I start producing at year 5. And maybe I'm going to produce for 20 years. For 15 years to year 20, since I used that in the example. Well, the way they used to do this before this new standard came out was they used to not set up a liability until they started producing. And when they started producing, they accumulated a liability based on units of production, kind of like a DD&A, units of production, right? So I'm not a good drawer at all, but let's say the production curve looks something like that. Okay, we're having a lot of wells come online the first couple years, and then of course everything starts depleting out. So what they were doing was taking a units of production expense each year in the income statement and then crediting a liability. So what they liked about that, though, was their expenses matched their revenue because it followed this curve. Their expense matched their revenue. When they had more production, they had more expense for ARO, right? When they had less production, they had less. Now we're not doing that. Now we're setting up this liability at present value way up here when we disturb the environment. And that's maybe almost 5 years before we start producing in this case, let's say. And then what we do is we take an accretion expense each year based on an increasing liability value. So this accretion expense each year is going to be higher than the year before because my liability value is going up. If I'm taking a percentage of a growing liability balance every year, then my accretion expense is higher every year. It's not quite a straight line, but it looks pretty close to a straight line. So this is basically what it looks like. Now, what companies don't like about this is, of course, as your revenue is going down, your expense is going up. It's not a great matching at all, right? It's not a good matching. In fact, some companies have said this may actually cause us to abandon fields or to sell off fields or abandon them earlier than normal. Now, when this statement came into being, the industry as a whole, like I said, that was 2003 or 2004, the industry as a whole, they were up here with their liabilities. The industry as a whole had to write down their liabilities. In fact, ExxonMobil had hundreds of millions of dollars of income that year because of this statement change. They had to take that into income, right? And across the industry they did. Now, what you don't like about that is that expense that's coming back. You're taking it into income, in the year you have to put the new standard in. But that expense is coming back up here, right, when your production's going down. So, again, it's not the way that they would like, I guess, to see it with a better matching of revenue and cost. We don't have it that way anymore because as our revenue is going down, our accretion expense is going up. But nonetheless, this is the standard and this is what we now have to do. Okay, so we've gotten to the end of year 2. Our liability balance is $3,503,385. Now, let's look at the reassessment. Assume that near the beginning of year 3, kind of doing everything at the beginning and end of the year, so we don't have to do partial years. But assume that near the beginning of year 3, management now estimates that the total future cost of abandonment and restoration is only going to be $9 million. Before we thought it was going to be $10 million. Now we're saying only $9 million. We'll still be able to borrow today at 6%. The present value factor for 18 years at 6% is 0.3503, and I gave you 7%, but there's not a need to use 7% here. In a little while, we'll see how different percentages come in. But we're still able to borrow at 6%, so there's certainly no need anyway. So what we should have in our liability, now I gave you 18 years because, remember, years 1 and years 2 have passed. This field has a 20-year life, so there's only 18 years of life left. So we're going to take the 18-year factor at 6%, 0.3503, times our new estimate of $9 million, we should have $3,152,700 in the liability. Well, we have more than that because we were expecting a $10 million cost. So our liability is at $3,503,385. We need to bring it down to $3,152,700. That means we need to decrease our liability on the balance sheet by $356,85, and that's going to be offset with a decrease to wells and equipment of $356,85. Now, again, we don't go back and redo any DD&A or go back and rechange anything from the past. This is an estimate change. Estimate changes means, we're going to put them in the year we know that the change or we're making the estimate change and carry those forward. We're not going to go back and change anything we did in the past. Okay, so at the end of year 3, we've now brought our liability down to $3,152,700. So at the end of year 3, we've got our accrete discount. That's the new liability balance at 6%. Our accretion is $189,162. The accretion is expensed on the income statement, and the liability is increased on the balance sheet, which brings the liability balance up now to $3,341,862 at the end of year 3. Now, assume that at the beginning of year 4, we now determine we're not going to have a 20-year life. We're only going to have an 18-year life instead of the originally estimated 20-year life. So we have to again, we've changed the estimate. We have to figure out, okay, years 1, 2, and 3 have passed. If we're going to have an 18-year life, that means we only have 15 years of life left. 15 years at 6%, that present value factor is 0.4173. We still think it's going to cost $9 million, but now the life has just gone down to 18 years. So $9 million times that present value factor of 0.4173, we should have $3,755,700 in the liability. We've only got $3,341,862, so we need to add $413,838 to the liability. That makes sense. If we're going to have to retire sooner than we originally thought, we need more in the liability today because we're going to have to get to that $10 million much faster. So we need to increase our wells and equipment on the balance sheet by $413,838 and increase our liability for ARO on the balance sheet also for $413,838. Okay, so you can see how changes in estimates of both the life and the amount are recorded and computed. Now, sometimes, though, depending on what's happening, you could end up with ARO layers. And I do know some companies that have this right now. There are some that don't. But some companies have the same interest rate today in effect that they had when the statement was first put into effect. But other companies have changed their rate. Again, your rate should be based on a risk-free rate plus an adjustment for risk based on the risk level of your company. Now, when you're revising upward, if the rate has changed, you need to add that additional amount that you're adding, that revision upward. The revision upward needs to be added at the new rate. So when you're revising upward, if your rate has changed, the new amount has to be recorded at the new rate. When you are revising downward, though, you're going to take out at the rate that was originally put in. So in this case, I'd be taking out at 6%, but if I decreased my liability obligation, that would come out at 6%. But if I'm adding a layer, or I'm adding $2 million to my estimate, that would be added in at 7%. Okay. So if we look at this, we're going to go back to the other example, start with that one again, and then change some things. So we're kind of familiar with it. Peters Oil is planning to drill offshore again on Block D. The drilling platform reaches location January year 1. We estimate it's going to cost $10 million 20 years from now. The interest rate is 6%. Present value factor 0.3118. Again, this is the same example as before. Present value, $10 million 20 years from now at 6% is $3,118,000. Wells and equipment, assets increased on the balance sheet. ARO liability is increased on the balance sheet. The end of year 1, we accrete discount. The liability of $3,118,000 at 6% is $187,080. Accretion is expensed on the income statement. The ARO liability is increased on the balance sheet. The ARO liability now goes up by $187,080 to $3,305,080. So that's our new balance. End of year 2, we're going to take that new balance, $3,305,080 at 6% to accrete discount, $198,305. That accretion is expensed on the income statement. The ARO liability is increased on the balance sheet. Again, we said this is the same, full cost of successful efforts, and for our purposes, we're going to say it's the same basically internationally in U.S. There are very minor differences. For our purposes, we'll say it's the same. So the ARO balance now, since we just added $198,305 to the ARO liability, is $3,503,385. Okay, based on a cost of $10 million. So we haven't changed that yet. Now let's assume that at the beginning of year 3, we now estimate it's going to be $12 million. So we're going upward. And now the appropriate interest rate for us has changed, right? If the risk-free rate changes significantly, right? Interest rates have been low. If those rates start to rise, then companies are going to have to change their interest rates, right? Because you're starting with the risk-free rate. You're starting kind of with that rate that's set by the government, basically. So the present value factor for 18 years, because we're at the beginning of year 3, we still got a 20-year life, but 2 years have passed. Present value factor for 18 years at 6% is 0.3503, but at 7% is 0.2959. Now we're going to use that 7% to add a layer of 2 million, because we only had a 10 million estimate originally. So at the beginning of year 3, we've got that layer at 6%, 3,503,385, but we have to add another layer using a 7% discount factor, which was 2.2959. We're increasing our estimate by 2 million, so we're adding a layer of 591,800, or 591,800, and that means our total ARO liability is now 4,095,185. Wells and equipment is going to be increased by the present value on that new layer, 591,800, and the ARO liability is increased by 591,800. Now the issue comes that when I accrete discount, I've got 2 different layers to accrete discount at. So end of year 3, accretion of discount, I've got to do it in 2 layers because I've got part of my liability in at 6% and part at 7%. Layer 1, I had 3,503,385 in at 6%. Accretion on that layer is 210,203. Layer 2, I added that layer in at present value at 7%, 591,800. That times 0.07 or 7% is 41,426. Total accretion is 251,629. That's expensed on the income statement. The liabilities increased on the balance sheet. Again, I've got to keep my balance by layers. Layer 1 goes up by 210,203. That's my 6% layer. Now has 3,713,588. Layer 2 goes up by 41,426 and is now at 633,226. My total liability is 4,346,814. So now I've got to keep my accretion by layers. Okay, before we get to that. Now, I didn't get complex into here what happens if they reduce, but I do want to mention it. Not going to give you a problem on it, but I do want to mention it. What happens next year if they come back and they say, you know, we first said 10, we then went up to 12, we're now going back to 11. What do? We've got 2 layers. The standard's going to tell us, why are we going from 12 to 11? What things are we reducing our estimates of? You know, were those items that we're reducing our estimate of, were those computed in layer 1? Or were those items that were added in layer 2? In other words, if we can associate the reduction of cost with costs that were projected in a particular layer, then we should take it out at the percentage of that layer. So if I say, yeah, I'm really reducing this by $1 million for costs that were initially considered in layer 1, well, then I'm going to take it out at 6%. But what happens if I say I can't associate it with a layer? Then I've got to use a weighted average based on the amounts, a weighted average percentage to take that out. Again, I'm not going to ask you to do a problem like that, but I think it's good to know how that's done. If you can associate it with a particular layer, take it out at the percentage of that layer. If not, you have to use a weighted average percentage. Okay, and the other thing I wanted to mention, we talked about PSCs. Again, at the beginning of the semester, we said in PSCs, production sharing contracts, or PSAs, production sharing agreements, companies are often required, this is where you might have a contractual obligation, to contribute to a sinking fund for ARO on a units of production basis. So remember in Angola, Senegal, right, you've got a 20-year agreement with them. At the end of 20 years, you'll go away. Senegal owns everything. They may produce another 10 years. So you're not even going to be there when the ARO actually occurs, when the retirement occurs. But the contract says you're going to contribute to a sinking fund. Anyway, units of production during the 20-year period that you're there, or during the producing period during that 20 years. So when the field production begins, payment to the fund is normally determined based on this kind of formula. What's my abandonment cost estimate less prior payments, or how much of that abandonment expected abandonment amount has not been funded yet. So what's my abandonment cost estimate less prior payments, or what hasn't been funded yet, divided by my estimated remaining total production from the field at the beginning of the year times my annual production. So it's kind of like a DD&A, units of production idea. What's my cost remaining? What's my estimated total production remaining? Times my annual production. These may be cost recoverable. If you're very successful, they're usually one of the last things that are cost recoverable. You've got to recover other types of costs first from the PSC, and we'll look at these kind of items when we get to revenue. But it may or may not be. It really depends on your contract. Okay, that's the idea on ARO.